Right now, a situation is unfolding in the gold market that almost no one is describing accurately. Over the past 30 days, $11 billion flowed out of gold ETFs in one swift move. Turkey sold off 60 tons of its gold reserves in just 2 weeks. Gulf sovereign wealth funds are withdrawing physical gold from London vaults at a pace unseen for the last 70 years. And gold, the very asset expected to rise during times of conflict, has dropped 21% from its January high. Every major financial network is focusing on the wrong issue. They're wondering why gold is declining amid geopolitical tensions. I want to flip the question entirely. Instead of asking why gold is falling during a war, I want to ask, what opportunity is this situation actually creating? Because after 4 decades of analyzing markets and debt cycles, I've learned one consistent truth. The biggest wealth-building moments in history rarely look like opportunities when they're happening. They usually appear as crises. And right now, hidden beneath all this turbulence, 3 entirely distinct wealth opportunities are opening up simultaneously. I haven't witnessed this kind of convergence since 1979. Stick with me here. I'm about to walk you through exactly what I'm seeing. In the next few minutes, here's what I want to cover with you. First, I'll explain why gold's sharp drop isn't what it seems on the surface, and why the forces driving it actually represent one of the strongest bullish signals I've observed in a long time. Second, I'll highlight a sector that very few experienced investors are discussing right now. Yet institutional capital is flowing into it in a pattern that echoes some of the most dependable energy market setups from the past 50 years. And third, I'll lay out what I see as the most mechanically predictable wealth shift in the pharmaceutical industry's history, and why the timer on it has already started ticking. These aren't just personal views. These are clear sequences of cause and effect. And recognizing those sequences is exactly what distinguishes investors who create lasting wealth from those who simply chase the daily news. Let me break down what's really taking place with gold. When markets experience an oil price surge at the same time as a tight monetary policy stance from central banks, a very particular dynamic kicks in. Highly leveraged funds, the ones running sophisticated multi-asset strategies, find themselves in a bind. They're typically positioned long on energy and short on volatility. When oil climbs above $110 a barrel and the Federal Reserve indicates it can't lower rates due to persistent inflation, these funds start receiving margin calls. And when margin calls hit, the first thing they liquidate is their best performing asset. Gold had surged 65% in the 12 months leading up to this correction, making it the most profitable holding on many institutional portfolios. So they sold it, not because they lost faith in gold, but because they had no choice. The numbers back this up. Research from BNP Paribas on commodities points out that during the major economic shocks of 2008, 2020, and 2022, gold initially declined as investors offloaded their strongest assets to generate cash. In each of those instances, once the forced selling ran its course, gold rebounded and went on to reach fresh record highs. Here's the key point I want you to grasp. $1 billion exited gold ETFs in March 2026. This wasn't everyday retail investors cashing out. This was institutions responding to margin pressure. The fundamental reasons to hold gold, de-dollarization trends, massive government budget shortfalls, and central bank reserve diversification, remain completely intact. What shifted was purely the technical landscape. The price declined because of who was selling, not because gold's underlying purpose had changed. JP Morgan has kept its end of 2026 gold price target steady at $6,300. Deutsche Bank is holding at $6,000. Neither institution has adjusted those forecasts downward. That difference between today's roughly $4,300 level and those higher targets isn't mere speculation. It's based on what typically happens once the pressure selling ends. I've spent 4 decades examining debt cycles and major geopolitical shifts. When I examine the current environment, I recognize a recurring pattern that reliably emerges at critical turning points. The pattern is simple. Periods of peak confusion create the largest disconnects between current prices and true underlying value. Right now, that disconnect is appearing in 3 separate areas at once. Investors who grasp the underlying mechanics, rather than just reacting to surface-level headlines, will be able to get positioned ahead of the broader market. But before I dive into each one, if you appreciate this kind of big-picture, systems-based market breakdown, please subscribe now. Subscribe now. Let me clarify exactly what forced selling involves, since many people mention the term without fully understanding how it works. When a hedge fund operates with leverage, say at 3 to 1, and the value of its holdings falls by about 33%, it becomes technically insolvent. The prime broker steps in and demands immediate cash. The fund doesn't hunt for the cheapest assets. It looks for what can be sold fastest. The answer is almost always its most liquid and most profitable position. In March 2026, that position happened to be gold. Turkey offers a clear example of what emergency liquidity demands look like at the government level. The Turkish lira recorded its 11th straight all-time low against the dollar in the 16 trading sessions after the Iran conflict began. The Central Bank of Turkey holds more than 111 tons of gold at the Bank of England. Bloomberg noted that officials were weighing the option of using that gold as collateral to support the lira. In the interim, they sold around 60 tons on the open market. India turned into a net seller as well. Gulf sovereign wealth funds, including ADIA, PIF, and others whose moves often aren't publicly detailed, appeared in London bullion market flows as an extra 45-ton withdrawal beyond the usual average. Here's the crucial detail I want you to remember. These players didn't suddenly lose confidence in gold. They simply needed immediate dollars to cover oil purchases that had jumped 40% in cost compared to 60 days earlier. They were liquidating assets they'd prefer to keep in order to handle a short-term obligation. And history shows a consistent follow-through in every cycle I've analyzed. Once the emergency passes, once oil prices stabilize and currency strains ease, those same players return to the market. They don't return casually. They come back with urgency, driven by their official reserve diversification requirements. The World Gold Council projects that central banks will purchase around 850 tons of gold in 2026, nearly matching last year's buying pace. The long-term buyers never left. The recent sellers were only temporary. Now, silver presents a somewhat different, and in certain respects even more compelling, picture. Unlike gold, silver benefits from two distinct demand drivers: investment demand and industrial demand. In 2026, silver is experiencing its fifth straight year of industrial supply shortfall. Solar panels, electric vehicles, and AI data center infrastructure all represent price-insensitive buyers of silver. They require the metal to manufacture the technologies the modern economy depends on, regardless of cost. Yet silver is currently priced significantly below what its industrial fundamentals would indicate. The divide between paper silver, futures, ETFs, allocated holdings, and actual physical metal has been one of the most persistent structural imbalances of the past 10 years. I've observed it widening over time. Eventually, that gap narrows, and when it does, it tends to happen rapidly. The long-term bullish case for both precious metals hasn't shifted at all. What changed temporarily was the price, which in the near term is always dictated by the most urgent seller in the market. Right now, those urgent sellers are active, but that situation won't persist forever. This next part often catches people off guard, and I get why. The word coal isn't typically linked with investment potential. For the past 10 years, it's been tied to contraction, strict environmental rules, ESG policies, and divestment by large funds. Institutional money has largely steered clear. Coal producers have faced chronic underinvestment, and that's exactly what makes the sector noteworthy to me now. Let me outline the dynamic at play. When Brent crude oil exceeds $100 per barrel, it alters the cost equations for every other energy source worldwide. Utility companies don't base decisions on ideology. They base them on simple math. When natural gas prices surge due to disruptions in LNG supply chains, as is happening now after Qatar Energy invoked force majeure on contracts following incidents at the Ras Laffan facility, utilities begin seeking the most economical option available. That option is often coal. In Europe today, generating electricity from coal-fired plants is currently less expensive than from gas-fired ones. That's not a statement about politics, it's purely a matter of current pricing. European utilities are rebuilding coal stockpiles ahead of a heating season that could stretch longer and prove colder than projections from 3 months ago suggested. In India, the picture is even more deeply rooted. According to the 2026 Energy Statistics India report from the Ministry of Statistics, coal still accounts for nearly 79% of the country's domestic energy supply, even as solar and wind capacity grows quickly. India's coal output surpassed 1 billion tons in the 2024-25 fiscal year, and consumption is expected to rise another 2.5% in 2026. With oil import reliance hovering near 89%, every oil price spike becomes a national energy emergency. The standard response has been to ramp up domestic coal production as much as possible. In the United States, the current administration issued an executive order in April aimed at boosting domestic coal output, including temporary waivers on certain environmental rules for existing coal facilities. This has led to upward adjustments in coal demand projections for 2026. Here's how the investment landscape appears. A full decade of ESG-driven divestment has sharply reduced capital spending in global coal mining, leading to tighter supply. Now demand is picking up again, not due to any fundamental change in environmental priorities, but because energy prices have shifted. That combination of limited supply and recovering demand is precisely the setup that drives the strongest commodity price rallies. I'm not proposing coal as a multi-decade hold. I'm pointing to a clear cyclical opportunity. The cycle was triggered by widespread capital avoidance, and it will unwind as capital flows back in. Between those two phases lies a tradable move. Metallurgical coal used for steelmaking has its own compelling demand tailwind. Every major increase in defense budgets throughout modern history has driven higher steel needs for ships, tanks, weapons systems, and defensive infrastructure. Right now, the US, Europe, and their partners are all committing to sustained multi-year rises in defense spending. Major banks are forecasting coking coal prices between $215 and $220 per ton for 2026 and 2027. You can't construct naval vessels without steel. You can't produce steel without coking coal. That supply chain is non-negotiable. Institutional flows are already showing up. Coal India, one of the world's biggest producers, has gained 11.3% year-to-date in 2026, even as the broader Nifty 50 index has fallen 6%. That outperformance isn't random. It's capital shifting toward a sector that most investors had been advised to shun. I've encountered setups like this before. In 1999, technology stocks represented the overwhelming consensus growth story, while energy was widely dismissed. By 2005, energy had dramatically outperformed technology. The exact mechanics aren't the same today, but the underlying structure is strikingly similar. Widespread avoidance leads to supply shortages, which eventually spark price surges and strong returns for early participants. The third opportunity is the one I consider the most reliably structured. By structured, I mean the key drivers are already locked in. The timelines are public. The revenue figures appear in company filings. Here's the reality. The worldwide pharmaceutical sector is facing the expiration of patents covering roughly $300 billion in yearly drug sales by 2030. This isn't guesswork. It's a concrete list of medications with fixed protection end dates. Keytruda, Merck's leading cancer treatment, brought in $29.5 billion in 2024 and is expected to reach $32 billion in 2026. Its main patent expires in 2028. When biologics lose exclusivity and biosimilars enter the market, sales can plunge by as much as 80%. Eliquis, the anticoagulant jointly marketed by Bristol Myers Squibb and Pfizer, loses U.S. patent protection in 2028. It generated $13.3 billion in combined revenue. Bristol Myers Squibb faces one of the largest proportional exposures, with 47% of its sales potentially at risk by 2030. Ozempic and Wegovy from Novo Nordisk, the semaglutide portfolio, delivered a combined $26 billion in 2024. Patents in key markets like Canada, India, Brazil, and China expire as early as 2026. These companies, their leadership teams, and their advisors all understand this timeline clearly. Their main strategy is straightforward: acquisitions. Pharmaceutical firms can't develop a new blockbuster medicine in just a couple of years. Bringing a drug from scratch typically takes 10 to 15 years and costs about $2.2 billion per candidate on average. They don't have that luxury, so they buy existing assets. Analysts at Stifel Securities estimate the total acquisition capacity of major pharma companies at around $1.2 trillion. Overall pharma M&A activity hit $240 billion in 2025, an 81% jump from the prior year. In just the first 2 weeks of January 2026, another $9.2 billion in deals were revealed. LEK Consulting anticipates more than 20 acquisitions valued over $1 billion during 2026 alone. Here's the investment dynamic I want you to focus on. Large pharmaceutical companies are actively hunting for smaller biotech firms that have promising drugs in their pipelines. When they identify a suitable target and complete the purchase, they generally pay a substantial premium over the current market price, often 30%, 50%, or even 100% higher. If you're positioned in the right biotech firm ahead of such a takeover, you stand to capture that premium. The issue isn't whether these deals will occur, they're already happening. The real question is whether you recognize the recurring pattern clearly enough to get in position beforehand. To be upfront about the risks, the biotech space has a high rate of failure. Clinical trials don't always succeed. Regulatory approvals can be postponed. Individual companies can lose nearly all their value. This isn't an area for heavy concentration. Any exposure should be spread out through diversified biotech ETFs like XBI or IBB, which cover hundreds of companies at once, or through the bigger established pharmaceutical firms that are actively managing the patent challenges via buyouts and product improvements. What makes this moment particularly powerful is how these elements are converging at once. The patent expirations create a motivated buyer with a $1.2 trillion war chest and a firm deadline. Advances in AI-assisted drug discovery are shortening what used to take 10 years into as little as 3. Meanwhile, the biotech sector, having hit bottom in spring 2025, has already climbed 75% and now offers valuation levels where both sides can find common ground. The transfer of wealth from big pharma's balance sheets to biotech shareholders is well underway. The pace is set. The dates are clearly listed in public reports. Let me tie these three opportunities together and share what I genuinely see ahead. The recent drop in gold and silver stems from forced liquidations, not any shift in their core fundamentals. The long-term buyers, central banks, strategic investors, and those focused on de-dollarization remain committed. Price has temporarily diverged from value. That divergence has always closed in past cycles, and it will close again. The renewed interest in coal reflects constrained supply from years of underinvestment now meeting rebounding demand. It doesn't signal a full reversal of the broader energy transition. It's simply a cycle playing out inside a larger trend. And well-understood cycles can deliver strong returns. The pharmaceutical patent cliff represents the most clearly defined opportunity I've observed in any industry over the past 10 years. The buying need is measurable. The potential acquirers are known. The schedule is public. The only unknowns are exactly which companies will be bought and at what valuations. What connects all three is a principle I've emphasized throughout my career: the crucial difference between price and value. Price reflects what the market will pay right now, under today's stressed conditions: forced sellers, margin pressure, oil disruptions, and panic. Value reflects what something is truly worth once conditions return to normal. The space between current price and real value is where meaningful wealth gets built. It's rarely comfortable. The times when that gap is widest are almost always the times that feel the riskiest. Back in 1979, gold experienced a sharp decline while the Federal Reserve under Paul Volcker aggressively hiked rates to combat inflation fueled by an oil crisis. Most investors exited. Those who stayed the course, or even added positions, watched gold more than double in the next 3 years. I'm not forecasting the exact same result today. I'm simply pointing out the identical underlying mechanism at work. Once you understand the mechanism, you don't need to guess the precise outcome. You just need to follow the sequence. Right now, that sequence is clear: forced selling, eventual exhaustion of that selling, return of structural buyers, and price moving back toward value. The three opportunities I've outlined are currently available. They won't stay open forever. Investors who focus on the real drivers, the mechanics, not just the headlines, are the ones who position themselves before the wider market wakes up. Let me wrap up with the current numbers as they stand. Gold is trading around $4,300, down 21% from its January peak of $5,596. JP Morgan's year-end target sits at $6,300, while Deutsche Bank's is at $6,000. That points to potential upside of 46% to 67% from here, provided the core thesis plays out. Silver is in its fifth consecutive year of industrial supply deficit, with the paper-to-physical imbalance stretched. Historical patterns show silver's recovery often follows gold's, but with greater intensity. Coal India has risen 11.3% year to date, while the broader market has declined. Coking coal price projections range from $215 to $220 per ton through 2027, supported by sustained defense-related steel demand. On the biotech side, major pharmaceutical companies hold roughly $1.2 trillion in potential M&A capacity, with over 20 large deals expected in 2026 alone, against $300 billion in revenue-facing patent loss by 2030. The window for this wealth shift is actively counting down. None of this constitutes personalized investment advice. These are simply observable data points and historical patterns. How or whether you act on them should depend entirely on your individual financial circumstances, time frame, risk appetite, and personal assessment. But the underlying data remains what it is. I'll leave you with one last observation. At every major market turning point I've studied, two kinds of investors emerge. The first group sees falling prices and assumes the fundamental story has broken. They sell or they sit on the sidelines waiting for things to feel safe again. By the time safety returns, the move has already happened. The second group asks a different question. Why exactly is the price declining? They then evaluate whether that reason signals a true change in value or merely a temporary change in who is selling and under what pressure. Right now, the reason is clear. Forced liquidations, urgent liquidity needs, margin calls, and nations covering elevated oil costs with reserves they'd prefer to retain. The intrinsic value of these assets hasn't changed. Investors who can separate those two concepts hold a meaningful edge, but that edge doesn't last long. Markets tend to become efficient over time, but they frequently become highly inefficient in the short term, especially during periods of maximum uncertainty. This is one of those periods. Three distinct windows are open right now. One, in gold and silver, where the gap between price and value is as wide as it's been in this cycle, triggered by forced selling that has no bearing on the long-term reasons to own them. Two, in coal, where 10 years of ESG-driven capital withdrawal has created supply constraints that are now colliding with demand recovery sparked by the biggest energy price shock in decades. Three, in biotech, where $1.2 trillion of pharmaceutical buying power is pursuing solutions to a pipeline challenge that can't be fixed internally, with the entire timeline clearly spelled out in patent expiration schedules known to every major pharma board. I've spent 40 years observing these kinds of cycles. The situations that appear most threatening are frequently the ones that end up generating the most lasting wealth. The sequence has begun. What you choose to do about it and how you do it is entirely up to you.